Okay, so let's get started. This is the weekend strategy report for the week of January 3rd, 2015. Hope you're having a good new year. The market has returned to bullish normal conditions on an annual basis using the weekly RSI 14. We're in the high end of neutral at 64 out of 100. The threshold for overbought would be 70 on that one. Short term, the 10-day NDX is at the low end of neutral at 29 out of 100. The threshold for that to go into oversold would be 20. So we're in the lower end of the shorter term market conditioner. Looking at the market mosaic, price with respect to the 200-day moving average is yellow bullish at 0.58%. So we're almost 4% above the sideways marker. The slope of the 50 is still strong, green bullish at 0.85. ADX with bulls in charge, still strongly trending at 25.8. The risk index, which is the 30-period moving average of the VIX divided by the 10, is reading at 0.97. The threshold between risk on and risk off is 1.0. So with the reading at 0.97, we are in risk off, but very close to the boundary of going back into risk on. Made a nice recovery these last 10 days. The risk Z is when we take that score of 0.97, compare it to the last 5,000 trading days, find the average and standard deviation, and compute the Z score. Call that the risk Z, and that's right now at minus 0.38. So this reading of 0.97 you see on this 90-day histogram of that indicator shows us at 0.38 standard deviations below the long-term average, and it's made a nice recovery here from a minus 2.5 Z-score and gotten right to the boundary of risk on. So that would suggest the market is poised for another leg up, just as we saw a while back. We get a nice almost yin-yang looking effect here as the volatility in the market goes from extremely noisy to extremely quiet. When the market is in this kind of condition, we're looking at intraday trading XIV, the inverse of volatility, and building swing positions with markets money for the long-term decay of volatility, which normally takes a long time to do. When it peaks, or when it gets above 1, we're starting to look for the turnover and the re-emergence of volatility. And when it starts to curl at a distance of at least 1 SD above average, then we're looking to preserve the gains in our XIV swing trades and just emphasize the intraday volatility trade on this downward slide. So these turning points at extreme conditions are of interest, and then the general location plus the slope. Tim did a really nice job at our last Tortoise workshop where he was looking at how he tunes his swing trading and in some cases using options with this indicator, and has found some very excellent returns by timing his swing trades to correspond to volatility conditions. And he's got a really nice presentation on that, and I'm hoping to have him record his follow-up work based on some guidance and ideas that we all provided him during our last workshop, which reminds me to say that I think this year's Tortoise workshop in June from the 5th to the 12th has the potential to be simply amazing. I've reserved all of the meeting rooms, so we have a lot of room to work with. I'm going to do this in 2 parts, a weekend research at a low cost, and then a follow-on week-long live trading for those folks that want to take some time and do some of that. What we're going to do with the research weekend is price that much lower than usual. We're going to have 3 different tracks, and I'll put all this out in writing, but it'll be a intraday focus, a swing trading focus, and the long-term, like blended monthly rebalancing focus. And we'll have people making presentations on their research in each of those 3 areas. We'll have a track chair who will kind of organize and keep that each of those tracks flowing. and each one will meet in their own meeting room. We're going to record all of those presentations, and I've hired a kid here from our high school graphic arts department to make a not a webinar, but a workshop recording of all the presentations, so that everybody gets a chance to have access to all of the presentations that are made. So each of the presentations will be peer reviewed. There will be papers and slides available, and then there will be the recording along with the question and answer. And my intent is to be able to package that and sell that as a workshop recording for folks that can't make it but who are interested in the topic. And I think through the DVD sales, we'll be able to offer a much lower price for folks who attend, and then use the broader interest to help subsidize the travel of folks who are coming. So I'm going to put that out in writing later this week. But I'm really excited about the possibility of developing a really top-shelf conference workbook, if you will, for folks that are interested but who, for whatever reason, can't make it. I'm going to be running a special track for folks who want to focus strictly on techniques that they want to apply later in that week for live trading, so there will actually be a fourth track, or that may be the intraday track, once we see how many people sign up and are interested. And then Monday through Friday we'll run the usual live trading week for folks who want to make a full week out of this. And again, we'll be able to do as many days of live trading as you want to do. It'll feature the Championship Kansas City Barbecue. Bill Scheit has agreed to come put on some drumming workshops for us, and there will be an opportunity to do the brain mode power work. There'll be some workshops on that as well, some presentations. I will probably bring in the inventor of that system to come and give us some insights into how to do that. All the conference attendees will have a chance to take brain mode power at a much reduced price if they haven't already. So I'm thinking this is starting to shape up as a very interesting and productive and valuable weekend and live trading week for all of us who are interested in these various techniques. So I think this will help us take collaboration to the next level. So I just want to put that plug in now and get you to thinking about it. And I'm interested in some volunteers for the track chairs that can help me with each of those 3 different lanes that I talked about, so that I can move from meeting room to meeting room and kind of overwatch the whole thing. So expect a flyer and a brochure on that this week. Just wanted to give you some ideas on that. So Tim's is an example of the kind of work that we do at the workshop. And then you'll find on YouTube the links to Sonal's and Jeff Bocassio's fantastic presentations at the last workshop, and that's an example of the kind of work that comes out of this research weekend. And so my sense is that by being able to price that the weekend, at least the research weekend, at a lower price, we can get some more folks to come and get the benefit from their presentations and make it accessible. And at the same time, I think the recordings are going to allow us to add even more value to the community, and then that will help cover the cost of all our infrastructure and whatnot. So look forward to a flyer on that one. Okay, so the blended monthly rebalancings, next reevaluation is due on or about 1 February. You can see the holdings right now. Still kind of a defensive posture with real estate, treasuries, and technology in ETF 13. And then these are the current leading candidates based on Friday's closing prices. ETF 2, the theoretical exposure is at 40%, and 50% is the theoretical, or is the sample model portfolio. And all we did on that was carried forward the holdings from December into the new year, and then reset the portfolio value at 50% for those of you following along. All right, let me shift back over to the regular report. Excuse me. Okay, next up is oh, let's see. I got to reset this, don't I? Okay, shifting back over to the regular report now. Just a quick look at the leading candidates in each of the categories. Again, you can see the defensive plays in the U.S. are still dominating in the ETF 13 and 32, and it's really all the globals are still lagging, with Latin America and Australia suffering the most right now. In ETF 32, again, the broader look at the world market model here. Again, you can see the laggards are the BRIC countries, Latin America and Brazil, emerging Europe, and then the commodities tracking fund just getting crushed here. That's a large contribution to DBC is oil, which is about half of that index, which is why that's getting smoked. But meanwhile, it's really the U.S. Defensive plays in the large caps. You can see how all of the XL series are really dominating, and that's really a function, I think, of or a large contribution from the strong dollar scenario that seems to be, I think, a macroeconomic condition that's likely to continue as Europe tries to jumpstart its engine. They're going to continue to devalue their currencies, and so are the Japanese. And so I think that's all contributing to strong dollar. And when that happens, you see that link up with the U.S. large cap. So the XL series, in my view, still stand to benefit from global economic conditions for our purposes. Looking at Etf Max, this is looking at about 1,200 ETFs or so, and the ones that run to the top using blended monthly. You see dominated here by China, biotechs, treasuries, U.S. real estate, retail holders, and more. A bunch of healthcare starting to come in here with. And then you see the U.S. medical devices, utilities, and real estate, and the utility sector spider. So these are all the U.S. large cap defensive plays that are holding on to the leading positions right now. And then when we carry that forward to look at the leaders in the S&P 500, you're still going to see that to be the case. Staples, CarMax, Southwest Airlines benefiting from their long-term energy posture with respect to the price of oil. And now you can see the XL ETF, the XL series ETF that each of these S&P 500 companies are members of. So if we're looking at drilling down, like on XLY and XLV, these are the ones you can find that are dominating each of those sector spiders. Next up is the market health check. Yeah, Martin, XLY is doing, I guess there may be some other candidates in XLY that are not doing so well. In the ETF 32. Maybe there's some, I think there's probably just some separation inside. It's still a fairly broad index, being consumer staples, if I recall right. But I think that's such a diverse set of companies that some may be more or less affected by energy, which will get some real separation between the winners and losers. So my sense is that the ones in XLY that are really winning, you can focus on them exclusively, whereas you might want to be on XLV or XLP if you just wanted the outperformance of the broad sector. So I think there's a case to be made in XLY that what we want to do is be looking at the companies, the individual components where it makes sense. In the health check, these vertical blue lines represent 10, 20, and 30 days worth of look back. And the horizontal red lines are support levels that used to be resistance levels. If price were to collapse, they become price targets on the way down. It takes us all the way down here to around 193, 194, which is the 200 period moving average, that solid red line in the shaded area underneath. The dark blue shaded area is the river. That's the 30 period Bollinger Band plus or minus 1. The lighter blue shaded area is the floodplain. That's plus or minus 2 of those standard deviations. The three blue lines in the channel is the 10 period regression line and channel, which is and the outer boundary of that is the channel is formed by the maximum excursion from the regression line during the look back period, and then the 30 period lagged by a day are the black lines in the black channel. You can see both of those are basically horizontal, flat, and I think that's an indication that this early sell-off here in early December, has now been reestablished in fair value going into the year end, basically at all-time highs at the previous swing high, and then I interpret the last 3 days of selling just as some backing and filling on very low volume, just going into the new year, and so I think we'll start to see some of the new year buying starting next week. Everybody's kind of back to work and looking to start moving out. You'll notice the thin black line that looks like a sine wave with the blue circles. That's the slope value of the 30 period regression line, which I use as a proxy for market health at any given time for the short-term market health. You can see it's it closed just above the dotted line, so we're just slightly positive. Each of the blue circles represents either a turning point at an extreme condition, or where it crossed the zero line, where the slope line went from negative to positive, or from positive to negative. You can see that starting around the Thanksgiving time frame, where it had peaked, that previous 30 days was really strongly up. It was extraordinarily strong. It was at 0.7. In fact, anything above 0.4, this green line, is at more than a standard deviation stronger than the long-term historical average. And so those moves of that magnitude, that slope function was really extraordinary. It pulled all the way back to the zero line, which is this dotted line in the middle of the chart, indicated by this blue box over here. That dotted line is the zero line. And so the slope came all the way back to flat and dipped just underneath it briefly, and now has rolled back above it. And now you can see we're hovering just slightly above the positive slope value for the 30. So that makes this a natural place for the market to find support. And then if it does, that's a really excuse me, good long-term story, because then you have a support level here at 197, and then look back to the previous big swing low at 182, and then we have this nice sine wave finding support. And then I would take any breakout above 209 as a really strong indicator of the next leg up. And then we've seen the last time that it did that, if we just want to use some symmetry here, let me get a better color. The last time we had this condition, we had a swing high, a sell-off, came back up and hesitated for a little bit, and then we got a nice move here from 200 to 210, which is about a 5% move after it breaks above the previous swing high. So if we say the market doesn't repeat itself, but it does rhyme, then we'd be looking for a 5% move on this next leg up, were it to clear this 210 or 209.5. Let's call it 210, and that would give us a target of about 220 is where we would look on the upside, just based on symmetry within the market and the size of the of sustainable market moves. So 220 is where I'm estimating the next positive swing if we get this this move breaking above 209. If that fails, then we have support levels here at 207, 202, and 199. 199 is really where I would pick up a downside bias when we get into this red zone, where I want to be, my focus is going to be shorting the weakest targets. Right now we're inside this yellow zone, and so on my intraday trade, that means I'm looking to wait for the market to vote each day and then trying to get in tune with that. What that means is that I'm willing to go long or short, just letting the market put me into the trade. The short side positions I take, I use to hedge and buffer against my swing trade positions. But were the market to go up, then that's really me doubling up and going turbo on long side positions. And so I look for these kinds of big white candle days that you can see here. But then at the same time in the yellow zone, we get a lot of large range red candles going against the long-term trend, and then we see those more frequently in the yellow zone. So that's the general strategy that I use based on market price location within like the last 30 to 90 days of look back. So we have a market that's behaving like an enduring bull. It's making a series of higher highs and lower lows in nice long swings. And my latest interpretation here is that we are well postured at a support level. Let's see if I can zoom in here a little bit so we can get a closer look at what I'm describing now. So this is a zoom in on the last 10 days or so, last 20 days, I guess. So when I frame this market condition, really I look at a price going above 209 would be a really strong vote to the upside, and that's where I think 220 for swing trades is reasonable. We are holding right here at the Bollinger Band mean, which is really the long-term fair value. We've had a nice rebound and orderly pullback on low volume, and then that's the argument for a resumption of the long side trend. The slope of the dragon is still positive, although it's just starting to roll over, as you would expect after 3 days of selling. So I would expect to find support here at 205, find support at about 202.5, and remember, this is all everything here in the yellow zone is all noise for long-term positions. You know, they take a look in it all the way down really to about 190, or if we said that the 5% off the swing high is noise for them, you know, 5% below 210 is down around 199. So I treat this all as this is just the noise zone for long-term market participants. Anything between -5 and -10% is where they're looking at. They would start calling it a correction if it got below 199, all the way down to about 190. It wouldn't be till it got below 190 that they would be interpreting that as the potential beginning of a bear. And so that would tell us we would see bear market around 190. Of course, that would be well into the into bear market by our market classification anyway. So so we're in good shape there. So what I'm looking for again is support to be held. I would not be surprised by support at 205, and then I'm buying rebounds and resumption of the long-term trend. And then if it gets above 209 is where I really am committed to the long side by default. As long as I'm in the yellow, I'm looking to go either direction based on how the market is developing. If it breaks below this the floodplain here around 202, that's where I would really expect to see some volatility increase. And then if it breaks below 199, I definitely want to be short. And then what I'm on that play, what I would hope to see is a violation of 197 would be a chance to get double short as it comes down to test the 200. So I want to have good short positions on in the red as it tests that previous swing low down here. So I'm prepared for 3 different scenarios here in the broad market, and then I will use the normal techniques in order to refine my target selection for intraday trading and swing trading. When the market's going up, I'm looking for the strongest positions to get stronger, and that would lead me to U.S. large caps. In market weakness, I would be looking for the weakest to get worse, and that would lead me to look at global opportunities like Latin America and Brazil, and then follow the price action further from there. Okay, so that's the market health check. Let's get back to normal viewing. Here's a quick look at the top regions of the world market model using the ETF2 lens. And so we've got 4 of the indexes on a buy signal and 6 on a cash signal. So that puts the market model allocation at 40-60. We're in bull normal. SPY is greater than the global, so the U.S. is still dominating the global, so 61 is better than 51, so it's still the U.S. all the time. Inside the U.S., it's technology at 62, and then small caps at 62, and then large caps and mid caps. I give a little bit of a hat tip to SPY here just because it was so strong for so long that I'm not really using this last week of temporary weakness to punish it. I'm keeping it slightly above IWM, but IWM, the fact that it had a pretty good week compared to the S&P, it to me is a bit of a tell towards the long side traders who are looking to front run maybe the small cap. So a strategic scenario for that would be the idea that annual rebalancing is going to see money in the U.S. moving from the large caps, which outperformed, over into small caps, which underperformed. So if we take the idea of annual rebalancing occurring in January, it wouldn't surprise me to see some outperformance short term in the small caps, and that may be an opportunity for us to get long intraday to ride that temporary wave. Now, it won't be till the end of January that we can go back and reassess and see if there really was outperformance in small caps and if that's going to continue for the year. But that's certainly one of the dominant themes for me for the January intraday trade, is to look for where there are days when the S&P is indicating up and the small caps, U.S. small caps, are outperforming. That's really where I want to get them while they're running, and by focusing on the small cap futures contract like TF, or looking at the leveraged ETFs for the small caps. So there's something to look for there. Inside the sector spiders, I should say also that the 2 weakest sectors continue to be emerging markets in Latin America and by extension Brazil. Inside the U.S. large cap sector spiders, you can see that utilities and healthcare are still dominating the defensive plays in the green. And energy continues to suffer from the price of oil. Moving on. Next up, world market model. Everything U.S. is above average. Real strength in treasuries and U.S. real estate. Maybe that's some hedging action as people are cashing some of the equity large cap money and stuffing it into the alternate defensive plays in the U.S. You'd expect both of those to do well in a scenario where there's a conservative equity growth model that wants to feature the U.S. and now is trying to get some alternate asset classes in there. That would allow those two those two assets to continue to do well. You can see all the commodities, especially oil, gold and silver, still well below average. Japan, Asia less Japan, below average. Everything Europe below average. All of the European countries suffering here. Canada doing not as bad as Mexico and Brazil, but Latin America and Brazil really getting crushed. Inside the Asian countries, it's Hong Kong, India, Philippines, and Indonesia. We saw some selected strength inside China, so that's certainly not a broad holding, but there's some possibilities in there. Looking at the business sectors, you can see it's the U.S. dominating the globals in every case, and the strength in utilities and healthcare is also manifesting in the global ETFs as well. Technology is holding up relatively well across the board, and everything energy is getting smoked, whether that's U.S. or global. ETF top 30, biotechs, real estates, utilities, biotech, real estate, treasuries. This one is interesting, the China FXI. That's a relatively narrow index that may offer some opportunities there. It's also has the advantages of being green and white, so it's a relatively early in its outperformance, along with the home builders, XHB, also green and white. And here's the global real estate, green and white, and the Alpha Dex, green and white. So these are all have a high average volume, so they're all liquid, and continues the trends that we've seen over the last really 3 months in terms of where the market strength is. Inside the Dow 30, the leaders continue to lead, Visa, United Health, 3M, and Home Depot. We've seen a little bit of a pullback here in what were the winners, which was Nike and Procter & Gamble, though they're still very strong. When we're looking at the green and white, that leads us to look at Disney and Goldman Sachs. Goldman Sachs has moved all the way up into the top 7 here. There was a time when they were way down here in the yellow zone. We're seeing weakness now in DuPont and Microsoft, which are white and green, so cautionary tales there. But clearly the top 3, 4, 5 here, Visa, United Health, 3M, Home Depot, Walmart. That's that conservative U.S. large cap in play. Relative weakness here, which is yellow and white in AT&T, Merck, and Verizon. Yep. So that's where we are right now. Shift into the daily report. Only a couple mechanical signals here, a couple overreactions and a 5DDs and some triple screen 551W. The auto framer is looking at agriculture and commodities, Procter & Gamble, Merck, and oil. There is a channeling signal here in the Qs. And again, I like this posture here in the risk Z. There's some real room for range expansion here going forward for swings and for one day. The volatility has peaked. That's what that little move in the return to aiming back towards quieter times is what fuels this move in the risk Z. And so there's still a lot more room for it to come back to the long-term average. And so that's why there's room for this range expansion going forward. So there's some tactical opportunities, I would say. Looking at the Dow 30 tactical, We only have a couple that fire on the auto framer. In the RSI2, there's a half a dozen or so that are single digits in RSI2, and that's a good thing for short-term price improvement. To get into single digits on RSI2 means that there had to be a couple days of large selling, and so that may create a value opportunity. So GE might actually be of great interest to us. We saw GE was in the top of the Dow for the Dow 30. It's a 5DD. It was a big percent loser on Friday at down minus 0.8. It's got a 2 on the RSI2, so that's one that we could take a look at. So we'll look at GE on a 5DD. Here's Procter & Gamble on an overreaction long, and then Pfizer, which was a Dow strength leader, is on a triple screen and a 551W, so we can take a look at that when we look at charts of interest. So we'll look at Pfizer and GE and Procter & Gamble. And let's see, shifting now to the ETFs, looking for things of interest. Not much to choose from. There was lots of low volume pullbacks, which is where the that RSI2 value comes in. Only a couple test out well on the auto framer. Here's a 5DD in blended commodities. Here's an overreaction in XLP, consumer staples. Now that might be a nice one to be looking at. We will certainly look at XLP. It's been a relative strength leader long term, but here's a moment where we can maybe frame a trade on sale. It's got an RSI2 value of 3, and it's an overreaction long. So let's go take a look at that one. So that's 4 charts I want to look at. Let's shift out of this now. And oops. Okay. All right, let's take a look at, while we're at it, just my old pal CLF first, since we're here. Had a nice Z pattern last week. It went from Z to Z, and now has pulled back to the. Well, that was Friday's trade. That was a nice trade. Let me shift back to the daily. So now we're looking at Cliff on a daily. And I like the support levels here around 6, and I am long this one on a swing from 7, and I'm looking at targets up here at about 8.7. It's now at the Bollinger Band mean, so I'm going to make sure that I don't lose any money on this trade. But this is one that has lots of potential. A failure below 6 lets me go short. Let's shift down to. I actually want to look at FXI because that was sort of that anomaly in China, that narrowly focused index, while the rest of China is suffering. I would take any price above 42.25 as signs that what we have here is a really nice swing low, higher low, higher low. That was enough to turn the corner on the river, which is now flowing up, higher low, and now we're getting ready to test this previous swing high at 42.25, And so this would be, I would take this as a real positive sign, and then off we would go. Failure below here, however, I would see, fair value back around 40. So there's about $1.50 of a downward move just to get back to fair value. Long-term fair value is this bright purple line. That's the 270 regression line, which puts fair value at about 40.25. So all signs are pointing to up on FXI, but there's a potential for a reversion to the mean trade as well. So let's see. We wanted to look at GE. This is that 5DD trade frame. So this is nice. This is one where I'd be willing to play the 5DD failure, because then it's fallen out of the river after a Z trade that took it from 2390 up to 26. If it fails at the Bollinger Band mean and the river has rolled over, we now have a swing high, a lower high. We have the extreme move down. And now if we can get this failure coming down to retest 24, certainly within reason, with an intermediate target at 2440. But then a rebound here at the edge of the river to get back to fair value at 2550. There's an opportunity inside there. GE is very strongly correlated to the S&P, although it sold off more than the S&P did these last 5 days. So GE has an opportunity for a bi-directional trade. We're going to see something large. There was a lot of volatility on that intraday range on Friday, so expect a big move in GE. We'll take a look at Brazil. Very nice. This 3.5% loss over the last couple days is either the leading edge of a retest of 33, or it's an opportunity to find support at the bottom of the river and then find value at 38 at the Bollinger Band mean, and then 41. So, and then the long-term fair value up here around 44. So this is perfectly postured for a rebound trade or a continuation of the fail pattern. So Brazil has to be on your short list for intraday trading on Monday. We wanted to look at, I think Procter & Gamble was one. Yep, here's a nice, Procter & Gamble has been outperforming. Well postured here to buy it on sale at the Bollinger Band mean if it holds. So you've got a nice 5DD, looks like that's like a 4DD. Longer term support here. Here's the long-term fair value. We now can buy it makes strong swings. We've had a series of higher lows. So as long as it holds here at the Bollinger Band mean, then we have a reason to believe in that kind of a move to go up and test 94. But then failure here gets it down to the bottom of the river and support, and then to the long-term fair value. So again, this is one I think we can trade frame in either direction in a very satisfying way. So that trade frame would look like go long at 91 or short at like 89.75 with a range risk. That's your trade frame. Downside target is 88.50. First upside target, I would say, is the top of the dragon, and then the top of the Bollinger Band 2. So I would be looking at that kind of a move, and then I would want to be double long right there, and I'd like to be triple long this thing up here. So this is our yellow zone where we're waiting for the market to vote inside of the range. So very nice trade frame in Procter & Gamble there. I think Pfizer was one we wanted to look at. This is that 551W. You see, this is a more orderly move. What we have is swing lows, a series of higher lows. It's holding here where it's supposed to. You can see we're on the second dot up using the PSAR. That's good. So it tells us we have to be thinking about long. I like the fact that it was a higher low. The slope of the river is up. The 90 is up. The 270 is up. We're buying it at a comfortable support level, and that allows us to have targets of 3190, 3230, 3250, and then up in here. I think this 3230 is the reasonable price target to me. So this is one that I'd be willing to go intraday, and then if it breaks out above the high, that's where I want to have my second position in. So Pfizer has been so strong for so long. That's one will be I would be willing to go intraday. For the last one, let's just take a look at the U.S. small caps. Just for the heck of it, let's look at a 2-hour. We're going to shift now down to the 2-hour, which is a nice way to transition swings to intraday, in my view. We had really nice bottoming action here on Friday. There was an initial sharp shock down, and then it found support for the whole afternoon. That looks to me like guys buying inventory that they want to sell going into the day. So I would expect an early run up in the small caps, and it's very well postured with a Z trade here. I really like that. I really like that trade. If we take a look at what that trade looked like on last Friday, let's take a look at the 10-minute. See, this is failure to fail further. You had the initial rapid sell-off, which put you in a Z condition. There's a really nice support here at 117, and then the rest of the day was up, which you can tell by the dragon, and it closed strong, and yet fair value is still up here around 120. Anything above 119.20, you'll see a nice pop as it runs up to 120 in a hurry. So that's a nice intraday trade with futures. Okay, so we're a little over an hour there. We're right around the hour mark, I guess. So you can expect from me this week the June workshop, the research weekend, and live trading. So it's going to be a two-parter, and there's for those of you who it's feasible only for the weekend. I think you're going to find that to be a low-cost way to get some great barbecue and drumming, and some, I think, are going to be some excellent research presentations. And then as part of your registration fee, you will get the DVD of all the presentations at no additional cost, and that's the thing I'll be selling to folks to help offset some of our infrastructure costs later. So you're going to get the networking opportunity, barbecue and live drumming, and then the camaraderie. And you also get a chance to do some good work. And you know, if you've come to these before, that it's the doing of the work that really locks in the value. You cannot put a price on the importance of doing the work and presenting it in public in a trusted, safe environment with your peers to get some tremendous insights. So we have a lot to look forward to. I can't wait to get that done. So best wishes for the new year. Stay safe. Share the goodness with others. Take good care of each other and those around you. And look forward to another safe and prosperous year ahead. Let's make this our best year ever. And let's do well by doing good. So take good care, and we'll see you in the chat room.